How do you falsify the hypothesis? Well, the first thing, the first step, as I said, is to look at the numbers. You know, the easiest way the hypothesis can be falsified is that the numbers that the computer, because you start and you don't know anything about a company, the numbers that a computer has thrown up are false. There's some accounting gimmick, or that's why the first step is to look at the history of valuation, and what makes a company immediately interested if you see a drop in valuation. A company that's always sold at 10 times earnings, maybe there is a reason why it's still at 10 times earnings. But if a company was selling at 20 times earnings, now selling at 10 times earnings, there might be a reason. Now, the reason may be justified. The companies have a varied and complicated history, and the past is quite often not a good representation of the future. Companies go through changes. So that's the first thing. You want to make sure the numbers you're looking at accurately reflect the situation. You want to look at the history of that valuation, and once you've sort of concluded that on the basis of that analysis the valuation is compelling, you want to study the business and try to, and the trick there is to try to come up with the concept of normalized earnings. So it's not this year's earnings or next year's earnings, but what the company would earn in the middle of an economic cycle based on its characteristics, and that's where the more qualitative aspects come into play, because a well-managed company, if the company is well managed, and you perceive that the people behind the wheels are competent managers and capital allocators, that helps you a lot. Over time, I've learned how to be more selective in using this criterion. If I've learned, I think that the most important lesson I've learned in the last 10 years or so is that I have to resist more the temptation to go for price if the management that I'm meeting through webcast or visits, etc., is not as convincing as it should be. In other words, the weight that I put on quality of management is higher now than it used to be in the past. Then, of course, you want to look at what the street is saying, what analysts are talking about, not because you want to take their expertise, because, of course, the average expertise of analysts is as good as the average expertise of fund managers, which is 0, right, on average. But you want to have an idea of what analysts are saying, and what it gets interesting is where you see that highly rated analysts are sort of repeating the same kind of justification of the price level that you think is behind the undervaluation. Another investment that we talked about in the past was Barratt Development. When the stock was at less than £1, I have a stack of brokerage reports justifying that price because that was the state of the real estate market at the time, etc., etc. So just following my method, you feel lonely. Basically, most of the times, I feel lonely with Ferrexpo. You know, when I talk to people about Ferrexpo, people immediately raise their hands. But Barrett went from less than 1 to 4, and that's a kind of reward that I'm looking at. Ferrexpo is a company that does not make sense at less than 10 times earnings. And at the moment, that would be twice the price.